Welcome to the YouTube channel of Michael J. Swanson. Michael is the author of How David Beats Goliath and is the CEO of Advocate Capital. And now, here's Michael.
Well, hi everybody, it's Mike Swanson here in Nashville, Tennessee from our video studio at the headquarters of Advocate Capital. Thanks for tuning in today. We're going to talk about law firm finance for plaintiff lawyers. So let's get started, shall we? I hope this will be interactive for you. And I hope that you will feel free to ask questions in the chat box or the questions box. And joining me in the studio today is Rachel Markin and also our producer for today, Amanda Unterreiner. So they'll be watching for your chat and your questions. So first of all, this webinar is brought to you by Advocate Capital. Advocate Capital is the purveyor of the AdvoTrack case expense funding service. We help hundreds, literally hundreds of law firms around the country achieve their goals and get better results for their clients. But this webinar will not be about Advocate Capital. If you have questions about us, visit advocatecapital.com and click on contact. We'd be happy to speak with you and put you in touch with your rep. There's also a handy find your rep button. Click on that and you can talk to the person in charge of your state. Okay, so this is me. I am the CEO and president of Advocate Capital. It seems like there's a lag. There we go. That's me. So I'm the CEO and president of Advocate Capital. I'm one of two owners of the business. We've owned it since 2001 when it had one customer, and now we have about 488 law firm clients around the country. I also wrote a book called How David Beats Goliath. This is the only finance book ever published to help plaintiff lawyers get results for their clients. And we're having a bit of a technical lag today. It seems like the slides aren't sharing there. It's going about 10 seconds behind, so I'll have to stay a little ahead. So I wrote the book to help plaintiff lawyers because we believe in what they do. We are Seventh Amendment advocates here. And in fact, I don't keep any of the profits from the book, although it's for sale on iTunes, barnesandnoble.com, and of course, Amazon. We donate all the profits to the AAJ Seventh Amendment Fund. So today, we're going to talk about some things that you didn't learn about in law school or even in undergrad. Most of you probably have an undergrad in political science, history, English, something like that. So you didn't learn about business or finance in undergrad. Then you went to law school and they didn't teach you much about that in law school either, right? So we're going to cover a few different topics today. The first is we're going to cover two basic financial statements, and that would be the balance sheet in the income statement. We're also going to look at the 10 most common sources of capital that plaintiff lawyers use to run their practice. We're going to do a deep dive into 3 of those 10. If you want more details, they're all explained in my book. By the way, if you're watching this and you'd like a copy of my book, I'd be happy to send you a copy. I'll autograph it for you. Just reach us through the comments here or reach me through the website and we'll be happy to send you a copy. We're also going to look at recommendations for your law firm, some general finance recommendations, and then recommendations specific to if you're going to do a transaction, mainly a loan, since you can't sell equity in a law firm to a non-lawyer. Okay, so my goal today is for you to learn at least one new thing that you didn't know about before, but also to take away 3 practical items that you can actually use at your law firm to begin managing it even better. Okay, let's get started with the first of the 2 items we're going to talk about today that are financial statements, and we're going to do a couple polls. So polls enable us to be a little bit more interactive, all right? So our first poll today is going to be, what period of time does a balance sheet cover? So on your screen now you can see a multiple choice poll. So take a look at those options. Is it 1 week, 1 month, 1 year, all of the above, or none of the above? So please click on one of those. This is anonymous. We won't know, if you voted or didn't, or what your vote was, and people are starting to vote now. So take a look and select one of those. Okay, people are starting to vote so far. Most people say all of the above. Votes are still coming in. We're going to give you another few seconds here, and I'll take a sip from my Advocate Capital mug. Okay, the votes are still coming in. Looks like most of you have voted. I'm going to give you a couple more seconds here. Okay. All right, so I'm going to close the poll. So most of you said all of the above, and one of you said 1 month, but actually it's a trick question. Okay, so the trick question is that a balance sheet doesn't cover a period of time. A balance sheet is a snapshot in time. So sorry about the trick question, but don't feel too bad if you got that wrong. The right answer was none of the above. Only one of you got none of the above, which is the correct answer. So great, let's take a look at what a balance sheet is. I like to think of a balance sheet as a net worth statement. And real simply, net worth can be thought of as what is owned minus what is owed is something left over that we can call net worth. Now, on a balance sheet, we don't use those terms, right? On a balance sheet, what is owned is called an asset. What are owed are called liabilities, and the difference between those two is called equity. So they mean the same thing, they're just different words for the same things. Now, if you were to look at an actual balance sheet, it's not going to look quite like that, and it's normally configured with the assets at the top of the balance sheet, and then the section below that, you see the liabilities and equity. So it can be a little confusing, right? Why are the assets at the top and the liabilities and equity are combined at the bottom? So let's take a look and see why that it's structured that way. Well, so we start with the simple formula of assets minus liabilities equal equity. And remember algebra, you can add things to the same side of the equation, to each side of the equation, and it doesn't change the equation. So we're going to add liabilities to both sides. So that cancels out the top liability and it adds it at the bottom. So now we have assets are equal to equity plus liabilities. That's starting to look more like the balance sheet. We just switched the liabilities and equity, and now it starts to look like that structure that we had on the actual balance sheet, that assets are supported by liabilities and equity. Well, I always thought that was confusing until I really did a little research about why it's configured that way. And one of the things to ask is, where do assets come from in a business? Well, those are the things that are owned, right? Well, how does a business become an owner of things? Well, there are two ways, really. The first would be to borrow money and purchase things. So borrowing or liabilities is one source that a business can use to acquire assets. And the other would be what's called equity. And equity refers to either the paid-in capital that the owners put in at the beginning of the business combined with the profits, the retained earnings from the business. So this starts to make sense, doesn't it? Assets then are supported by liabilities and equity combined, and that's why a balance sheet looks that way. So back to the balance sheet. Well, here's what we're going to ask you a question. This is not a poll, but start thinking now, what is your law firm worth? If you have a contingent fee law firm, look at your balance sheet. What assets do you own? Probably not many. You may list things on there like, I don't know, future fees, but they're really per GAAP not an asset. So most law firms have very little net worth. Although you may think that your law firm is very valuable, and certainly it's valuable to you, when a lender looks at that or another financial professional looks at that, your balance sheet's going to be very thin. You probably rent your equipment, rent your office space, maybe you lease a vehicle. And so your assets, especially if you include your IOLTA account on your balance sheet, that's not really your asset. So when you look at your assets, it's not worth as much as you should, or as it could be. So that's going to be talked about later when I talk about some recommendations. You should be building net worth outside the law firm because it's hard to build net worth inside of a contingent fee law practice. All right. I don't see any questions yet, so we're going to move on to the next financial statement. It's a little easier, actually. But let's talk about another poll here, and we're going to say, what time period does an income statement cover? This one's a little easier, I think. Is it 1 week, 1 quarter, 1 year, all of the above, or none of the above? So you're starting to vote. That's good. Pick one of those. All right, the votes are coming in. Don't be shy. We can't tell who's voting. We don't know what your answer is. All right. More than half of you have voted. We'll leave it open for another 5 or 10 seconds. Good. Okay. Anybody else want to come in before we close it out? Okay, so most of you got the correct answer on this one. The correct answer is all of the above. And that's because an income statement covers really any period of time. It's very flexible. You could run an income statement for 1 day, for 1 week, 1 month, 1 year, 1 quarter, whatever you'd like. So it has a starting point and an ending point. And in an income statement, what we're looking at is what you received minus what you paid out and what's left. So we don't call those things those names on an income statement. We call them typically income or revenue minus expenses. What's left over is usually a profit, although sometimes it can be a loss, right, if expenses exceed income for that time period. So that's pretty straightforward. We'll take a quick look at an income statement, not in detail, but you're going to see income at the top minus your expenses. What's left over is your profit. Pretty straightforward. Great. We'll talk more about financial statements and your responsibility regarding them later in the webinar. So great. Let's move on now. We're going to talk about in this next section the 10 most common sources of capital or money that plaintiff lawyers use to fund their practice, mainly the case expenses. And you see them on your screen now in alphabetical order. And they're not listed in order of what is most expensive or least expensive, but I am going to ask you a question. This is not a poll, but I'm going to ask you a question to think about of these various forms of capital. And you might not be familiar with all of them, that's okay. Which one, just make a note, which one you think is the most expensive source of funds for your law firm, and which is the least expensive. So just take a note off to the side, and we'll see how you do on that one. So I think you'll be surprised. If you are a plaintiff lawyer, one of the most common ways of accessing capital in the market and most comfortable is also potentially the most expensive from a financial standpoint, and that is fee sharing or co-counseling. So this refers to when a law firm brings in another co-counsel or fee shares, if you will, mainly for the financial benefit of having the other law firm finance the case expenses. So if you're doing that at your law firm, you could be paying a very high effective annual interest rate. Now, fee sharing has positives, right? There's no collateral requirements, no underwriting, there are no monthly payments, you can have bad credit, there are no UCCs filed, and potentially you can get a lot of leverage based upon your overall net worth. It's comfortable because you're working with another lawyer, probably a close friend, and there is a certain risk abatement there because if that other firm is taking on the risk of losing, well, there's some economic benefit to that as well. But we're just going to look at the arithmetic in a moment on why it might be more expensive than you think it is. And the main negative is that it does have potentially a very high financial cost. So the effective interest rates we see anywhere from 50 to 150% interest rates. Let me show you an example to see how we come up with numbers similar to that. So here's an example of a case that's going to be worth $100,000 at settlement or at verdict. And it's a typical case where the client will end up roughly 2/3. The law firm is going to split its fee with another law firm for getting access to $10,000 in order to finance the expenses, right? So if this is you, you're going to cut your fee in half down to $14,850 in exchange for getting the use of essentially $10,000. So my question to you is, what is the effective annual interest rate? And we have another poll for that, and I'm going to launch that right now. So looking at the numbers you see on your screen and assuming that the case lasts for 1 year, do you think the rate is 14.85%, 48.5%, 148.5%, or 841%? So cast your vote. Again, it's anonymous. We won't know who got it right and who got it wrong. Just having a little fun here. Let me give you, again, a little time here. I can tell it's going slower, so some of you have your calculator out. That's probably good. If you're not sure, just pick one. Okay. About 1/4 of you had voted, so some of you need to get busy here. Just pick one. Okay, you're shy with the numbers. I understand. You have an undergrad in history, right? If you wanted to be an accountant, you would have been one. All right, once we get over the 50% mark, we'll go ahead and close the poll. Come on, a couple more folks, take a shot. One more of you needs to vote. Here we go. Okay, we're going to close the poll. With a 50-50 split between 48.5% and 148%. We also had a couple people at 841.5%. So the answer actually is 148%. So the math on that is you're taking $14,850. That's what you're giving up. You're paying to get the use of $10,000 for a year. So when you do your math on that, the effective annual interest rate is 148%. That's a lot, isn't it? Did you realize that maybe you were spending that much if you're financing cases with other law firms just to get access to the case expenses? You may not have thought about that. On the flip side, if you have access to capital, whether it's your own or from a lender, and you're on the other side of that transaction and you're able to put in $10,000 and you get $14,850 in a year, you've made 148.5% return on your $10,000 investment. So this can go two ways. Which side of the transaction do you want to be on, right? Do you want to be on the side that's paying that rate or the side that's achieving that rate? All right, let's continue. The second form of capital that we're going to talk about for financing case expenses is actually the most common, and that's a law firm partner's cash, right? So it's the most common one because although it's not been a requirement for plaintiff lawyers to fund their own case expenses, it's been, you know, the best choice until recently because who else is going to pay for it? The plaintiff can't pay for the case expenses. So there are benefits to the partner using their own cash or partners. So there's no collateral required, no underwriting, no monthly payments. It's easy, it's comfortable, bad credit's okay. You're not having UCC files in your law firm, but there are costs to that. Costs that I think sometimes are not fully appreciated. And I actually have a separate webinar. Go to advocatecapital.com videos, click on the webinar link, and one of my webinars is called the 9 Hidden Costs of Self-Funding Your Case Expenses. We won't go into detail here, but I do an entire webinar and video on that. I think we have a white paper too. So the negatives mainly are opportunity costs, the time value of money, phantom profits where you're earning profits. Your accountant says write a check for taxes, but you don't feel like you actually made the money. Where'd the cash go? Went your case expenses, and also low liquidity. Now it's hard to put an exact number on the actual financial cost of using your own cash. We do have a calculator on advocatecapital.com to help you estimate that, where you can put in some real life numbers of the number of dollars you have on the street and for how long. And essentially it's calculated as an opportunity cost. The opportunity cost is what would it cost you to get your cash out of your cases? And then what could you earn in terms of a return by investing it somewhere else? So our best estimates are at least a 6 to 10% effective annual interest rate for funding your own cases, but it could be much higher if, for example, you have the ability to take that cash out and invest it maybe in a new practice area. Maybe you want to buy into mass torts and you think you can get a return of 20 or 30%. Well, leaving your cash tied up at 0% effectively is very expensive in terms of the costs. Let's look at one more of the 10 of the forms of capital, and this is a relatively new form. Relatively new because it's been on the scene for about 20 years, which in the history of our company is our country is fairly short period of time, but it's really come on strong in the past 5 or so years, and that is a loan with interest pass-through. So most of the time it's a non-bank finance company loan, and there's the pass-through, the borrowing cost to the cases themselves. So the positives are that it is the lowest net cost form of capital that you're going to be able to access as a plaintiff lawyer. There's no way to get better cost of money even just from a straight bank. And the reason is that most plaintiff lawyers get back their case expenses about 95% of the time. So in this scenario, you would get back 95% of what you pay your lender in terms of the borrowing costs. So that means your net cost will probably be well under 2%, maybe even under 1% a year. And with prime at 5.5 right now, if you're paying your bank 5.5 or 6.5, obviously 1 or 2% is a lot less expensive than just eating the interest from your bank. Now there are some negatives for that. You're going to have good credit. You're going to have to pledge your accounts receivable at least, or maybe all of your law firm assets. There's additional reporting, right? Because you're dealing with a third party. You're going to want to see financial statements and these kinds of things. They're going to file a UCC on your law firm for sure. You're going to have monthly payments. You'll be dealing with non-lawyers, which is kind of uncomfortable, and you have to go through the underwriting process. But if you are a well-managed firm with partners who have good net worth and good credit, this could be a very good option for you because it's going to be the one advantage that you have that no other business has, really, to be able to pass through the borrowing costs to its actual cases or clients. The effective annual interest rates, as I mentioned, anywhere from 0.5% to 2.5%, depending upon your success rate. If you're only getting your expenses back 80% of the time, well, your net cost is higher. We have firms who win every case in a year, so their net cost is 0 for that year, so it's somewhere in that range. Okay, very good. We're going to move on to the recommendation sections of the webinar. I don't see any questions yet. If you have them, feel free to type them in, and Amanda will get my attention, hopefully. All right, so the first section of recommendations will be general recommendations. These kind of would apply almost to any business or anybody watching this this webinar. So that's the first section. The second section will be recommendations about getting a loan as a plaintiff lawyer. So first, minimize interest. So if you think about interest, you're paying someone else to use their money. It's kind of like rent, right? So you're kind of renting someone else's money is what you're doing. And over time, you should be able to control your expenses, both as an individual and a business, and allow your revenues to catch up to them such that you should be able to build up your own capital needs on your own in terms of retained earnings. That should be the goal. So the idea that I'm putting forward is, over time, you should be paying less and less interest every year. Take a look at what you're paying each year in interest on your annual income statement for the law firm. Factor in any reimbursed interest from your cases if you're using that form of funding, but also look at your personal statements. Look at your credit card statements. How much interest are you paying on your, your car notes and your credit cards and things like that, your mortgages. And you should know what that number is. How much are you paying to rent other people's money every year? Ideally, that's going down, and ideally over time, you can reduce the amount of debt you have and minimize the interest you're paying. All right, another one, pay off your credit cards. That's one of the first things you should be doing. If you're not there yet, control your expenses and get so you're paying off your credit card every month. Credit card rates are typically relatively high in the marketplace, and credit cards can be dangerous to your credit score and to your access to capital. A lot of what we learn over time is looking at the financial statements and applications of law firms who try to be our client. We take about 280 applications a year from law firms. We only fund about 1 out of 4. So we learn a lot of things from the folks who apply and we don't approve at first. We kind of coach them to eventually fit into our box. We actually have law firms who will come to us that have 10 credit cards all maxed out, and they've started up their law firm and maxed out their credit cards. Well, maybe if your first year, that might be an okay strategy, but if you're 5-10 years into it and you're still carrying balances on your credit card each month, I think you're probably doing something wrong. You need to rein in your expenses and get those paid off. Now, my wife and I use a credit card because our children, I live in Tennessee, our children live in Ohio and California, so we're always buying airline tickets to fly them here, or we're flying there to visit them. So we like the Southwest card, get a lot of points and a lot of free miles that way, but we're paying that off every month and we're not maintaining a balance. Another danger of credit cards, not just the high cost, it's that the credit cards, if you read the fine print, which nobody reads, they have the ability to unilaterally pull back your credit card limit without your approval. We saw this happen a lot in the financial crisis when a lot of the banks got into trouble and wanted to preserve their liquidity. Across the board, many of them were just pulling back on their credit card limits for their clients, even if the clients had no slow payments, no problems. And what that caused were problems for the clients, right? Because what happens is, if you have a $10,000 credit card limit and your balance is $5,000, you've used 50% of your available credit. Okay, that's part of the equation of your credit score. Now, if they pull your limit back to 5,000, it looks on paper like you've maxed out that credit card and you're used 100% of that. Well, what happens there is if 2 or 3 credit cards do that to you, your credit score is going to go down. Guess what happens then? They pull back further because your credit score is now a low score, right? Or your rate goes up. So it's very dangerous. The other thing is, if you read the fine print, many credit cards, if you're late on one payment, they have the right to jack up your interest rate from whatever it is now at 12 to 15, 18% to 29.99%. So if you forget to put a stamp on your payment envelope and you're late on your payment, you can see your interest rate double or triple. So that's why credit cards are dangerous. They're really not an appropriate source of funds to long-term finance a law firm. Okay, next is credit score. We just talked about that a little bit. It's important that you know your credit score. If you don't know your credit score, there's no excuse for that. You can get it for free every year. Many of you I know were like I was in my 20s. I didn't want to know my score. It's like, I'm afraid to look, right? But you should know it. So one of the services that I use now personally is called myfico.com. I like it because you set it and forget it. You sign up, I think it's $75 a year. I don't have to remember to check it. They text me and email me 4 times a year to look at my updated score. And it's important to know the score because I've written articles on this as well. You can check out our blog for it. Having a high credit score now is more impactful than ever. It can affect you in so many different ways. I go into an article on the website on that. It can affect your mortgage rate, the lease rate you pay in a car, what part of town you can afford to live in. All these different things now, unfortunately, are driven by credit score. So you might say, I don't care, it's just a number. You should care. It can make a big difference economically to you, and therefore your ability to help others, to be generous, and to provide for your family. So credit score is something important to know, important to work on. All those sites, by the way, give you ideas to get your credit score up. And so you should know what your credit score is. Okay, if you don't need capital, great, good for you. You got everything financed, got a lot of money in the bank, terrific. Well, you might need it, right? Because you might get disabled, or you might have an employee steal from you. It happens. So the time to line up sources of capital are not when you need them. Don't wait until you have your worst year ever, like many law firms do, and they call us and we can't help them. If you're having your best year ever, that's the time to secure capital for future needs, right? Because your credit score will be high, you have plenty of net worth, everything's going well. So don't wait until you need capital. Too many law firms do that. They think that we're there to bail them out of having a bad year, and unfortunately, we just can't help them. They wait until they have a tax lien or they have other issues. So don't wait until you need capital. So this next point is probably one of the two most important points that I'll make today, and this is to have an emergency fund. I've written articles on this topic as well, so I won't go into detail here. But an emergency fund is not a line of credit, right? So an emergency fund is not, I have access to a bank line of $200,000 or $300,000 in case I need it, right? If you're having a bad year, tapping into debt makes your year worse. It undermines your net worth, okay? An emergency fund is cash in an FDIC insured bank account. That's an emergency fund. It's outside your law firm. It's insured by FDIC. It's cash you can access if you want to. So it's your choice if you want to take that cash and inject it to your law firm. Maybe you do, maybe you don't. If you've left it in the law firm, it's already at risk. So have an emergency fund both for yourself and for your law firm. So you should have at least 6 months worth of overhead and expenses of your law firm set aside so you can overcome the downturns. We all know in our business that a plaintiff law firm, there are ups and downs, both in months, but also years. You know, you might have one of those weird years where everything gets continued to the next year. Well, if you're going to solve that problem by getting into debt and undermining your net worth, that can cause long-term problems in terms of your credit score and et cetera. So a better option is to have cash set aside in a bank account you can access if you need it. Just as importantly is to have that 6 months of your own personal living expenses outside the law firm in your own personal FDIC insured bank account or bank accounts. If you need several bank accounts, FDIC insures up to $250,000. Again, I've written an article or two on this. Text me, Google me, whatever. You'll find that there are many reasons to have an emergency fund, but one of the best reasons is peace of mind. So if you have a bump personally or professionally, you know you're okay. You're not going to have to go into debt and dig a deeper hole. So build up that emergency fund. Now that's hard to do if you don't have it yet. You're going to have to pull back on expenses, and you're going to have to live below your means for a while. Have a target date. Maybe it's 3 to 5 years from now. You want to get there. Set aside whatever you need to get there. Just do it. You'll be glad you did. Okay. Next is pay down the most expensive debt first. Seems pretty straightforward, but we've had law firm clients who said, I had a great year. I'm going to pay down my Advocate Capital line. But then they still have, you know, a car loan open for 10% interest rate, or a credit card for 15% interest rate. Makes no sense, right? Because the Advocate Capital case expense funding service, they get back their interest. So the net cost is 1 or 2% per year. Why would you pay that debt down first? Pay down the expensive debt first. So if you have a great year, you want to reduce your debt, that's a good thing. Look at the interest rates on the various forms of debt you have and pay down the most expensive debt first. It's just a straightforward economic way to go, but we've seen law firms do the opposite. I'm going to talk a little bit about what's going to be in next month's webinar, and I'm excited about next month's webinar. It's going to be the proper accounting for tax purposes of case expenses for a plaintiff law firm. It's coming out in about 1 month, and in fact, when you get your email with a link to the video of this webinar, I think we're going to have a link to the next webinar. Is that right, Amanda? Yeah, good. So you'll be able to sign up for that. And one of the things we're going to talk about in that webinar is actually an IRS private letter ruling that's pretty infamous, in case you're familiar with this already. It's 824-6013. So this was a private letter ruling put out as an instruction to IRS auditors. And essentially what it says is that the money spent by a contingent fee law firm to fund case expenses are not expenses. Now, even though we call them case expenses, because they come back to the law firm so consistently, 95 to 97% of the time, the IRS says you should not be deducting them on your income statement, but rather treating them as a loan you've made to your clients. And the loan is an asset, and so that should show up on your balance sheet. So your case expenses should show up on your balance sheet, not your income statement. Now, this is not meant to be accounting advice. I'm not a CPA or an attorney. This is informational purposes only. But ask your CPA about this. Ask your tax lawyer about this. If you'd like a copy of PLR 824-6013, let me know. We'll send you a copy for free. You can go to our website and actually ask for that as well. And tune into our webinar next month. Sign up for it. Even if you can't attend, we'll send you a recording of that. And our guest is going to be Robert Wood. And if you Google Robert Wood, tax attorney, you'll find that he's a world-renowned tax lawyer. He represents mainly litigants. That's what he does, mainly on the plaintiff side, whether it's law firms or actual individual plaintiffs. And he's very well versed in this. Is what he does all day, every day. He's written on this topic, and he'll be our guest. So tune in for that, or at least look at the recording on that. So the thing to do, one of your takeaways today after the webinar is to look at your financial statements, look at your income statement, look at your balance sheet, and look for case expenses. If they show up on your income statement, you need to ask your CPA about that and get a copy of 824-6013 from us so you can help yourself on that. Okay, next, training. So there's a phenomenon in the plaintiff law firm world, and it's one of the most common mistakes that plaintiff law firms make, and I call it promoting the receptionist to CFO. Right? Because, hey, it's going great. We went from one lawyer to 5 lawyers. We have hundreds of cases. We're busy. We're making money. Gosh, we need somebody to do the books. Bob, you're a receptionist, but here's a copy of QuickBooks. Go on YouTube and figure it out, right? Huge mistake, huge mistakes. Very, very common though. So if you're going to put people in a responsible position of being the bookkeeper or being the CFO of the law firm, make sure they have the proper training. Either they have it from outside the firm and you hire them in, and they're qualified and they're degreed and they have experience, or you provide that training in-house. So if you're going to ask somebody to go from receptionist to bookkeeper, you need to provide the training for that. There's plenty of training online. There's plenty of ways for them to get qualified on that. They can get training from Intuit, get certified as a QuickBooks Pro advisor. We actually provide free training for our clients on QuickBooks and license discounts. If you're a client, let us know if you need help on that. When it comes to training, we love LinkedIn Learning. So it used to be known as lynda.com, lynda.com. We use it. Every employee in our company, all 45 employees, have a license to LinkedIn Learning. We have a freshman year, a sophomore year, a management level, 2 levels of office training. LinkedIn Learning is awesome because we pay one lump sum and it's unlimited training for every employee. It's trackable by employee, so our administrator can see who's taking what courses. They get their certificates, they turn them in. So check out LinkedIn Learning. It's fairly reasonable in terms of costs as well compared to outside sources. So make sure you're training people. Okay, financial statements, really important. Now we looked at an income statement and a balance sheet in very overview format. More importantly is that if you're a law firm owner, you need to be taking a look at those every single month, okay? You need to look at your income statement, look at your balance sheet every single month. And if you don't know what it is you're looking at, that's okay. Talk to your accountant, your CPA, and say, hey, I pay you to do my taxes once a year for $500. Once a month, I want to sit down with you for a half an hour, $100, $200, whatever that costs. Have them walk you through those statements, right? Start understanding what those numbers mean in terms of your law firm. And then have them drop them into a spreadsheet, right? January's numbers, February, March. Over time, you'll be able to track those numbers and expenses and revenues and look for trends, right? So you want to spot trends before they become a problem. We call that a common size approach to the financial statements. So the key, though, is to look at them every month. I probably spend 3 to 4 hours a month reviewing the financial statements of Advocate Capital. We then pay our outside audit firm, BDO, to review them. We pay them that. So we have professional CPAs also review them for us in addition to our in-house accountants. So they're very, very important. Yes, you're running a practice. It's an art form. It's a service to your community, but it's also a business. And if you're not familiar with them, it's okay. Start spending an hour or 2 a month looking at them, get some help from outside, but you need to be looking at those financial statements. Very important. Here's another tip for you in terms of preventing fraud. And I think I've done a webinar on preventing fraud too. You can check that out. Real quick, one quick tip for you on this is looking at your bank statements. So when it comes to your monthly bank statements, if they come in the mail still, if you're not paperless, if they're coming in an envelope from the bank, give instructions to your staff that those envelopes are to be unopened, but put on your desk. And you should personally open those bank statements and look them over. Now, if you're a big firm, there'll be a lot of entries. You might not know what everything is, but do this. Don't tell your staff I said this. Circle 1 or 2 things a month and ask for an explanation. What this does is it tells them you're paying attention. If someone wants to defraud you, if they're the ones kiting checks or whatever, they're going to know, hey, he's looking at the bank statements or she's looking at the bank statements. I need to be careful and find someone else to steal from, right? So open your own bank statements, review them, look for things that look out of whack. And if nothing else, just circle a couple items and say, I want to see these 2 invoices or I want to see these checks. Get in the habit of that. It takes 5 minutes. Costs you nothing, but it's one of the things you can do in terms of preventing fraud. And again, I have a separate webinar on that. You can look that up on our videos tab on our website to get more into depth of preventing fraud. All right, another thing to do that's really easy. All of you watching probably have access to Westlaw or LexisNexis. Are they the same now? I don't remember. Anyway, one of those forms where you're looking up legal documents. So once a quarter, maybe, have your assistant do an adverse filings check for your law firm and for you personally on those lookup services. You're looking here for liens or UCCs that lenders or other entities might be filing on you that you're not aware are there. And probably about half the time when we take an application from a law firm, we say, have you pledged your accounts receivable to another lender? They say, no. It's just a personal guarantee. Well, we do a UCC check, and guess what? Their bank filed on all their assets. They didn't know that. The bank may have filed incorrectly, maybe not. So you should know ahead of time, quarterly, what UCCs are out there, who's filing liens on me or my law firm. We had a client come up for renewal in California, and we did a UCC search, and they've been a client for, I don't know, 5 or 10 years. And what we found was that a disgruntled client of theirs had logged onto the Secretary of State website and paid the $50 fee or whatever it costs to file a lien in California, and filed a totally bogus UCC on them for $2 million because they were unhappy with the legal services they got from the law firm. Well, kind of a nightmare, right? Fortunately, that was a bogus UCC, and we were able to see past it pretty quickly. But it would have been better if they knew that was there before they came at renewal time with their lender, right? So keep your eye on UCCs. Again, no cost for that compared to what you're doing now. As I said, there are 2 really important things here. I talked about one of them, and that is to build net worth outside your law firm. And the second is this one. I think this one's the most important thing. If I could give any plaintiff lawyer advice and they listen to one thing I said, this is it. Build net worth outside your law firm. Pay yourself. You're in business to make money. It's not a crime to make a profit. Live within your means and take that cash and invest it in whatever your advisor tells you to invest it in. But build net worth over time outside your law firm. So important. We see extremely experienced, well-known former trial or association presidents come to us in their 60s and apply to become our customer, and we have to turn them down because they've left all of their capital in the law firm over time. They've built up a law firm, it's well-known, they have a lot of employees, but other than the law firm, they're broke. So don't be that person. You might not want to retire, but when you get in your 60s, it'd be nice to be able to, right? So build net worth over time. So what you should be doing there, looking at your personal financial statement once a year, just like a balance sheet, right? So you're going to look at what I own that actually has value, not the law firm. Okay, what do I own outside the law firm? What do I owe? And what's the difference? That's your net worth, all right? Write that number down. Check it again in a year. Has it gone up? If not, work on that. pull back your expenses or pay yourself more. So that over time, you're increasing that net worth over time. You'll be in a better position to help your family, obviously, and yourself, but also your clients, right? Would you want to hire a plaintiff lawyer who's super experienced but broke? No, absolutely not, because their access to capital is going to be limited. So build net worth over time. All right, those are the general recommendations. We're going to move now into the last section of the webinar, which are transaction-specific recommendations if you're considering a capital transaction, which in our industry means a loan, right? Because you can't sell stock in your law firm to a non-lawyer. So we're essentially talking about applying for a loan. So here are some tips from a commercial lender. On 1/3 of the credit committee, we've reviewed thousands and thousands of law firm applications, financial statements, tax returns, and here are some of the things we've learned over the years from the industry. First is get a term sheet. So a banker is a sales rep, and they may be on a bonus, and they get a bonus by putting dollars on the street and loaning money to law firms. So there's a little conflict of interest there. Are they going to reveal all the terms when you talk to them on the phone? Maybe they'll conveniently forget 1 or 2 of the terms. So if you're going to consider doing business with a lender, get a detailed term sheet. That should lay out not just the interest rate, but any fees, all the collateral, any assignments of life insurance that might be required, all the details of a potential transaction. Then hang on to that, because if you move forward, you want to compare that term sheet to the loan documents, right? Did what they say in the term sheet and in their conversations with you make it through to the loan documents? Sometimes they do, sometimes they don't. You'll be able to call them out and say, whoa, wait a minute. The rate in the term sheet said this, but my loan document says that. So it's really important to get a detailed term sheet. It should be signed by an officer of the company or the bank. Another bit of advice if you're going to do a loan, and that's to match the benefits of the loan to the term of the loan. So one of the more common, I think, mistakes we see is a law firm goes to Mass Torts, Made Perfect, great conference. They get stars in their eyes, and there's a hedge fund there, and the hedge fund says, look, if you can buy $1 million worth of mesh cases, you'll be a billionaire, right? So they say, great, I'm rich. The hedge fund gave me $1 million at 20% interest rate. They buy into a bunch of cases, and guess what? The judge throws out a case or something. They make no money off of it, or not nearly as much as they thought they would, but they're stuck with the debt. And that can be a long-term debt now. So they might owe that $1 million for 20 years when they got 1 year's worth of benefits from it. It's kind of like going to a restaurant and buying a meal on a credit card that you don't pay off, right? You pay $200 for the meal. What did the meal really cost? Well, 10 years later, if you haven't paid it off, you've paid interest every year. It really costs you maybe $500 or $1,000 to eat at that restaurant in reality. Same thing when you look at borrowing money for your law firm. Try to match the term of the loan with the period of time you'll be getting the benefit of those two if you can. It's important to think about that. Another concept, debt is not equity. Going back to the balance sheet, remember we saw that assets on the balance sheet are supported by 2 categories, right? Liabilities, which is debt, and equity, which is the paid-in capital or the retained earnings of the owners of the law firm. Well, those are 2 different things, right? They're on separate sections of the balance sheet, and there's a reason for that, because liabilities or debt function differently than equity. So I'm one of the owners of Advocate Capital. If we wanted to grow even faster, we could issue stock to other investors. They could invest in Advocate for some stock we could give them in exchange for that. And then those investors, those equity holders, would share pro rata in the profits and the losses of the firm, right? And if it's straight equity, there's no monthly interest payment. It's just a straight sharing on a percentage basis of profits and of losses. Well, debt doesn't work that way, because you can't go sell equity. If you're going to access capital through debt, you need to think about that, because if you're going to allow a lender, if you're going to grant them a security interest in your law firm assets, especially your accounts receivable, that puts them in a very powerful position, much more powerful than a minority investor in a business, because that lender can shut your cash off, right? So we have seen many law firms who borrow way too much money with a secured lender at a high interest rate in the 18 to 22% range, and then they have a bump in the road. Well, that lender is going to get paid. So where can the law firm cut back? They can't cut back on their interest payments, so they cut back on marketing, they cut back on staffing, they cut back on draws for the partners, right? Because they have to pay that lender, or the lender can shut their cash off. So be very, very careful when getting into a lending relationship. It's not equity. They're not going to share in your losses, and they're going to demand to get paid every month. So be careful about that. We have seen applicants here at Advocate where their lender, and we see it on the income statement, where you see what they're paying in interest, is making more than the partner in the law firm, because we see their compensation as well. And that's a really sad place to be. So don't get there. Get some professional help, by the way. Hire a business advisor or a CPA if you're considering a transaction. All right, contracts and loan documents. If you're a plaintiff lawyer, you probably aren't reading loan documents all the time. So you need to hire, especially if it's a large transaction, hire the right lawyer, which we'll talk about in a moment, but read the documents. Now, most larger lenders, banks, and finance companies like Advocate, for example, credit cards, etc., you're not going to be able to really redline the document. It's not so much to go in there and hack it apart. You can't redline your Visa fine print, right? It's either take it or leave it. That's kind of how it is in the finance world. But the reason you want to read it is so you know what it says, right? You need to know what are the potential pitfalls if I have a problem. What are the rights of the lender? What things can they do to my practice? What rights do they have in terms of access to information? So you need to read that and make sure you're comfortable with what the loan documents say. We have law firms come to us and they say, can you get me out of my lender? Great, what's your interest rate over there? I think it's 8%. We say, send us a copy of the loan documents. Lo and behold, it's 18% because they hadn't read the loan document. So just read them. They're boring. They could be long, but read it over. You need to know what it says. And the other thing is hire the right attorney. If it's a large transaction relative to your revenue, not a credit card, but a large commercial transaction, there are lawyers who do the same thing every day, all day, like you do in your practice. All they do is read loan documents every day. Well, they're experts on what is in market and what is out of market for a commercial lending document. That's what we do. We have lenders to us. Some of the largest banks in the country are actually our lenders. We hire lawyers who do nothing but read loan documents all day to read those for us and tell us what's in market and what's out of market. So spend a few dollars. Don't assume you're going to know the right thing to see in the loan document. Hire the right lawyer. Next, don't borrow too much money. Getting over leverage is no fun. You have a bad year, you ask the bank for another increase. Before you know it, you owe the bank $1 million, you're only grossing $1 million a year. We see too many law firms in that situation. You're better to pull back on expenses than to keep digging a hole deeper. If you find yourself needing to borrow more than 1/3 of your annual revenues, you might have a business problem issue. You might be becoming too dependent upon debt. So if you're grossing, let's say $1 million a year in fee revenue, you really shouldn't have to borrow more than $350,000 to fund your case expenses to do that. If you find yourself feeling like you need $1 million of debt, bring a professional in, have a CPA, I'll take a look at your capitalization structure. It would be safer to grow slower, or more slowly, I should say, and to use your own retained earnings to grow rather than getting yourself deep into debt. Ask about funding sources. If you're dealing with a non-bank lender, right, a commercial finance company, in the financial downturn, the last crisis, almost everybody in the industry, it was only us and one other lender that kept making loans through the whole financial crisis. All the others just shut people off. And the reason they had to do that was they were dependent upon hedge funds and private equity money. And that money's very, what should I say? What's the word I'm thinking of? Can go away quickly. Fickle. So that money is very fickle, and they get their funding cut off quickly. So if you're going to do business with a non-bank finance company, ask them to explain to you what's your source of funding, how dependable is that funding, what happened in the last downturn, were you able to make loans? So be careful about that. Also, check references, okay? We're all Googling people every day. You're going to do business with somebody, Google them, check them out, look at reviews. But reviews can be toyed with a little bit. So it's safer, in addition to Googling them, ask them for references. They should be able to easily give you 3 references of existing customers, and then have your questions ready before you call them. How long have you been doing business with the lender? How did you get started with them? How have they been to work with? All these kinds of things, and call them and ask them, hey, I'm thinking of doing business with these guys. Any recommendations? If I move forward, what questions should I ask? What did you wish you would have asked or thought about ahead of time? So check references. It's worth it. We check references on everything, not just employees. If you're going to do business with a bank, good news is all bank data is available for free on the internet, fdic.gov. You can search that bank, look at their financial statements, or maybe ask someone to look at it for you or your CPA. Right now, the banking system is super liquid. Everything is great. There are very few problem banks right now. But if you're going to do business with a bank, I would want to do business with at least a medium-sized to large bank, not a little small community bank with under $1 billion in assets, because they'll probably get bought up someday. And you know how that is. You're doing business with this great local bank, and then next thing you know, you're doing business with somebody out of state you don't know about. So you can check all that out for free at fdic.gov. Kind of lastly on the recommendations, I'm going to talk about fixed fees a little bit. And you may have a loan now that has an interest rate and also an annual fee based upon the size of the loan. So I want to explain a little bit why you need to be careful about fixed fees. So let's look at an example to try to show you how fixed fees can really increase your cost of capital if you're not careful. So this example is a line of credit that has an annual fee of 2% of the line of credit, right? Which is in this case $10,000, and the interest rate's 5%. So let's do the math on that. If your average balance is $500,000, so if you get a line of $500,000, you borrow all $500,000, the math on that's pretty straightforward. It's going to be 5% plus 2%, so your all-in rate is 7%. Now let's look at a scenario here though where you only use half of that line. So now we're looking at an average balance of $250,000. Now the problem is you still paid the 2% on the $500,000. So you still paid that $10,000 fee, but you're only using half the line. So the math is on the screen. You're effectively paying a 9% interest rate. You might say, okay, 9% is close to 7%, no big deal. Well, the reason lenders like fixed fees like this is 9% is 29% higher than 7%. So a commercial lender, if they can get you to pay an annual fee on a line they know you probably won't use, they have the ability to greatly increase the effective annual interest rate. And in this scenario, the lender would be getting a 29% higher yield on its loan. So be cognizant of that. Try not to pay a fixed fee if you can. Better to pay as you go, so pay through an interest rate only if you can. If you are going to pay a fixed fee, try to only have it on the amount you think you're actually going to borrow. Okay, well, that's a lot of content. You might be thinking, so what on all that? So what is this? If you're a plaintiff lawyer, we know that you are the keys to the courtroom for your clients. And I don't care how good a lawyer you are, if you're first in your class, if you're a published author, if you're the president of a TLA, none of that matters if you have not run the business properly and you can't prosecute your cases to the fullest. Too often, there are two conversations that happen in plaintiff law firms. The one is, hey, we got this case of a lifetime. Let's settle some of these cases over here a little sooner to get that capital freed up to spend on this really big case. Okay, that's not right. Or, probably even more common, it's been a tough month, payroll's next week. Let's settle some cases a little early and get the cash. So you don't want to be that law firm. So having the right capitalization structure and access to capital for your law firm is just as important, if not more important, than going to the right law school or having the right experience. Okay, well, if you need help or have a question, I'll do it for free. I'm not a consultant. I don't hire out. If you're a plaintiff lawyer, I talk to plaintiff lawyers who are clients and not clients. We think that a rising ocean or tide lifts all boats up. Our mission is to help an ever-increasing number of plaintiff lawyers get better results. So I'd be happy to help you if you have a question after the webinar. We'll open up for questions in just a moment. Okay, and it's that time. It's time for questions. So let me give you a moment. For those of you who are watching, you can use the chat or the questions section if you would like to ask a few questions. Let's see, we'll turn that screen off for a moment. By the way, we're speaking to you from our studio here in Nashville. We created this video studio to create free content for people like you, plaintiff lawyers. Stay tuned for more webinars this year. And let's see if we have any questions yet. Okay. How much does Advocate Capital charge? Okay, well, we won't make a commercial for Advocate Capital today. We're happy to share that with you in a detailed standard terms sheet. So go to our website, advocatecapital.com, and click Contact, and we'll be happy to get in touch with you. Or you can click on the Find My Rep button at the top of the website. That'll enable you to let us know what state you're in and direct you to the right expert in your area, the right director of strategic solutions. Okay, any other questions? Okay. What does UCC stand for? That refers to the Uniform Commercial Code. That's the body of law that governs commercial transactions. A UCC is a term sometimes referred to as a lien. It's actually a lien. It's a UCC 1 statement under the Uniform Commercial Code under Article 9. Okay, other questions? Don't be shy if you have a question. We don't know who you are unless you tell us. Okay, good. Well, it looks like that's all the questions. Again, if you have one privately, just send me an email. Happy to help you with that. If you'd like a copy of my book, just let me know. Here's my contact information. Give us a shout. Also, the book's available if you want to buy it, if you prefer a Kindle version, something like that, or an iPad. If you'd like a signed copy, shoot me a message. I'll be happy to send you a copy of that. And we thank you very much for joining us today. That's all.
Thanks for watching. Send your questions or comments to Michael at mike@howdavidbeatsgoliath.com.